Hello, David Moore with Equity Advantage, 1031exchange.com. And today, you're not just stuck with me. I've got Tina Colson from my office here, and she's going to be testing Tina today, I guess. So, Tina, why don't you start off, tell us what you're going to ask me.
So today, I just really want to focus on exchange rules and uncovering a lot of the questions that are asked by our clients lately. And so I just want to start by carrying over the equity in an exchange. A lot of folks think that they can just take that equity piece only in the property and be fully tax deferred. But that's not quite true. Do you want to uncover that myth?
Sure. So, those of you that have not met Tina before, she's been with us for the last year. Prior to that, she was with Providence in their gift department doing charitable remainder trusts. So she's gone through a big year. It's not her fault that we had COVID, I guess, but she's been with us ever since we had COVID. But I'm not going to blame you for it. But, the idea is during that time, she's also found out that although I try to keep things simple in here, I like the old KISS principle, as my old buddy J.C. Kutnikoff used to say, keep it simple, stupid. But there's lots of industry lingo, and it might even boil down to terms like relinquished and replacement, from what I understand this morning. So we'll try to keep that taken care of. But one of your question's a good one, especially in times like we're in, because as lending starts to tighten a little bit, you've got a situation where maybe the loan to values decrease, and in recessionary times, which we're certainly not in at this moment, but a year from now we might be talking from that context too. Your equity sort of evaporates also. But when we look at what has to happen for an exchange, you need to satisfy what we call the napkin test. And the napkin test just simply says you need to go across or up in value and equity. And I think what you're asking me is, people often think, well, gee, the equity, all the net proceeds, that's my equity, that's all I have to spend.
Right.
Is that?
And let me give you an example of this. So let's say I have a property that I'm selling that is $700,000, and my equity may be $450 in that property. I want to downsize because I want to get rid of the debt. So I'm looking to purchase a property on the other side for $400,000, $450 to cover the full equitable amount. So why is that a problem?
Well, it's a problem because the government wants you to be going across or up in value and equity. And the value and equity number is going to be net of closing costs. It's not the gross. So you're going to back out, maybe 750 nets you 720, something like that. But whatever the adjusted sales price is, that's the bogey number. That's the number you have to hit for total tax deferral. And the net equity, whatever comes in, that has to be spent. Now, you hear people say all the time you have to replace debt in an exchange, which is not true. Debt can go away two ways, one by going down in value and the other by adding cash. But your question is one that comes up all the time because people think, well, gee, I only made this much on the property. This was what my gain is, or this is what my proceeds are. And they're just thinking that's all I have to do. And that's certainly far from the truth. You have to meet the value and equity requirements for total tax deferral. Now, I want to stress once again that it's not all or nothing. So if you sold at 750 and 500 is a perfect replacement property, and let's say your tax basis on the relinquished was 300, you're still deferring the difference between the 3 and the 5. So you're deferring tax on 200. You'd have tax exposure on the difference between the 5 and the 720 or whatever that adjusted sales price is. And I think really in today's world, more importantly than ever before, I really want people to understand it's not all or nothing. Defer what you're going to defer. I mean, and get what you want to get. Every dollar more you spend on something than what you have to, costs you a dollar. If you don't spend it, maybe it's 40 cents. So buy what you want to buy, and Tina's question's a great one. It's not what you've got in net equity that needs to be spent. It's not just your gain that needs to be spent. We call it the napkin test, and that just means you go across or up in value and equity for total deferral. And the easiest way to look at it when you're starting to measure effectiveness of an exchange is every dollar spent really beyond your tax basis should represent tax deferred gain. So buy what you want to buy. And just understand what the tax liability is going to be and be prepared to pay it.
So the second question that I had today is if I have a sibling who is looking to sell property and I want to purchase that property and I'm the exchanger, the exchange rules state that I can sell to a family member, but I cannot purchase from a family member. So how does that rule come into place, and is there any way around that?
So I think first off, we probably ought to look at who is a related party from the 1031 context. And if we're looking at, so we've got a sister company, IRA Advantage, IRAadvantage.net or .com, but we do self-directed retirement accounts there. And in that space, we're concerned about two issues. What are you going to buy and who are you transacting between or for the benefit of? And any transaction between or for the benefit of a disqualified party is a prohibited transaction. Most of the time, disqualified parties related parties in that situation. So if we look at related party transactions in the 1031 space, we're typically looking at lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. So any transaction between or for the benefit of one of those things, we've got to look at these rules. So as Tina mentioned, we in the 1031 space, we usually look at it and say, okay, you can sell to a related party, you can't buy from a related party. You asked about a way around it, or maybe it's an exception to that rule, would be you could there's two exceptions really. You could show you can do that transaction if you can document there was no intent to avoid any tax, which the argument there is, well, is 1031 that effort in and of itself? I don't know, talk to your tax people about it. But the other way that would allow you to buy your replacement property from a related party would be as if that related party was also going to do an exchange. So both the buyer and seller have to be doing exchanges, and they have to buy and hold each of the respective replacement properties for no less than 2 years. Like I said, with the sole exception of if you can document there was no intent to avoid tax, that rule wouldn't apply. But sell to one, that's fine. Buying from one, typically a no-no. Just the way it is. Why is it that way? I don't know, some senator, right? That's what I always like to say.
There's always a catch.
Yes.
All right, so let's talk about a couple of scenarios where we blend investment property with a personal residence. So I want to sell my rental property, do a 1031 to purchase a primary residence with a large home office. So is that possible? And how do I allocate the funds to do that? What does that look like?
So I think first off, we got to look at what's like kind in 1031. So like kind, when you're looking at like kind requirements, it refers to the nature of the investment rather than the form. So any real property held for investment is going to be like kind with any real property acquired with the intent to hold for investment. So the next question that comes up all the time, using what you're talking about, if you're giving up a property that is a pure investment, you want to go out and buy a replacement. It's either going to be a piece or all residential. Number one, you can't move into it right away because that you wouldn't have held satisfied the held for investment rationale. Now, with that said, there's a court case about 6 years ago now that allowed a transaction. They bought it after 4 months, moved into it. Okay, so that's an example of taking a pure investment and moving into it. And the question that often comes up, does it have to be rented? And whether a property's rented or not is really irrelevant. But that is possible. Now that's not what your question was. Your question was, what if we're talking about pieces of assets? Mm-hmm. So when we look at that like kind requirement, any real property held for investments, like kind with any real property acquired with the intent to hold for investment. What about a duplex? Let's say it's half owner occupied, half non-owner occupied. What are you selling there? And we're going to look at it, really say half of it's 121, section 121, the universal exclusion. The other half's 1031. Well, if you look at it and that's possible, why couldn't you have a home that has a portion of it? Let's say you do childcare at home, or you've got a large home office, or maybe it's a ranch with working land in the farmhouse. All these things are situations where you got a single asset with allocations different directions. So you're going to have allocations, Section 121, the universal exclusion, and 1031, and you're just sort of mixing and matching what needs to happen. But to answer your question, you can have a single asset allocations going different directions on the relinquished side. You can have the same thing happen on the acquisition side. But I think what you've seen recently is you've got a number of clients that want to take and move into immediately a portion of that asset, right?
Correct.
So if they're going to move into a piece of this immediately, that thing is not of like kind. So your choice, if you want to take 1031 money to go buy a property that ultimately you're going to live in, you're either going to have to wait to move into it, and that timeline is really, it's not up to you or me, it's up to the taxpayer and their tax counsel, but anyone that's telling you more than a year, I wouldn't buy it for any reason. 1 year I think is a safe amount because it's been proposed a couple times, and the break between short and long-term tax rates on assets held for investment, at least for now, until our current administration makes whatever changes they're wanting to make. But the idea is you're just looking at single assets, allocations, different directions, and you're going to work. This is why tax people are so critical. You want good tax people. You want to talk to them. You want to sharpen your pencil on the allocations. You want to maximize the universal exclusion and anything. And what I mean by that is take full advantage of the 250 or 500 exclusion you're entitled to, and then the overage would go 1031, and that's on a disposition or acquisition. You're going to look at those allocations, but on the down payment, you can't say, "Hey, I'm using all 1031 money to buy this property, and the equity from the exchange just going into the investment portion. I'm buying the residential portion, nothing down." That does not work.
And
Okay.
a part of what David is talking about, for those of you who are not familiar with the universal exclusion or the 121 as he's referring to, is personal residence and the exclusion of gain when you sell a personal residence. And so that is one piece that I just wanted to clarify too.
So Section 121 came in 1997. It replaced 1034, and for a property to qualify for the 250 or 500, you have to have lived in it for an aggregate of 2 out of the preceding 5 years. There's not an elective proration of those numbers, but I would expect that going through this last year, we've probably got a lot of people that through hardship are maybe looking at prorations of that, and you might be able to have a proration if you've got some hardship. So once again, you and I are not going to make that decision on what fits or doesn't. The tax people are. So I cannot stress enough, if you've got investment real estate, you've got much real estate out there, you need good tax counsel. I mean, they really are going to be worth their weight in gold to take care of you. Their job is to really, we say you've worked hard for your money, we work hard to keep it yours, and their whole job is to do that too. So.
Absolutely. And so along the same lines, a lot of folks now, again, because of COVID, we've got a lot of home offices that are being used as space. It falls into this same category. If I'm selling my personal residence, I've got 20% of my home as my investment that I've been claiming on taxes as my business space, and now I want to go purchase across and get another property and allocate that same amount. I think the deeper question that we need to look at is, if I am selling a property and I've round numbers, so $200,000 sale, and we've got 20% allocated for the home office, and I'm going across and I'm purchasing another property, I want to make sure that the funds that I am using for that exchange purpose for that office, when I go purchase the new property, is going to meet that same criteria of the value. So I'm not going down in value in that 20% of my new purchase. Can you maybe decipher a little more of that and clarify what that looks like?
It's really important when you're looking at a piece of something being a primary residence that you're really covering those ratios. So whatever the ratio is on the investment component, it's got to be, really should be the same on the residential component. Now, we're not scheduled to talk about that about this thing at this moment, but I will just mention that, let's say you're buying an investment property, tenancy in common, and you and I are going to go buy something jointly,
Sure.
which we can do. We can't go exchange into a property that we jointly would own as a legal partnership, a limited liability company or something, but we can always go tenancy in common. And we use that same structure if you're wanting to combine IRA 401k funds with personal funds via 1031. We have to use TIC because 1031 requires that. The retirement side does not. But the issue that comes up, a lot of times you'll have sort of an organizing sponsor to this investment, which might be the broker or a builder developer. And they're saying, well, gee, I'm not putting cash in, you're putting the cash in, so we're going to have to complete the transaction for you. And then this other person maybe ends up a TIC owner, and they might be coming in with zero cash coming in. It's going to be in kind there. So, you've got to always look at what's happening, and we might have, there's lots of misunderstanding out there too, that a TIC would have to always be the same loan to value on stuff, every member of that TIC, and that's not an absolute. I mean, there were institutionally offered TICs, a decade ago that we did a lot of work with, that everybody would have different loan to value, and the idea is it's like a condo. It's like a condominium project, right? Every unit has a different loan to value, and through the TIC, theoretically, you can have different loan to values on those things, but you've got to really look at how you're receiving what you're receiving. And by the way, if you're the broker and you're receiving a piece of it in lieu of commission, you got paid. So
Yes.
You're getting something, right? So whatever you're getting, it's not like you get it for nothing.
Gotcha. So just to recap on our conversation and make sure everybody is clear on what we're discussing about blending a investment property with personal residence. So one, we can allocate a specific percentage of a property that is a home office and purchase another specific percentage of a property as long as those dollar amounts match up on the other side for the purchase. But also the folks have to bring in the cash to cover their primary residence portion of that new property as well, correct?
Yes, I mean, so if you're looking at buying a mixed-use property or relinquishing, when you relinquish it, your tax people should have been taking depreciation on it, right? So those numbers should be there.
Yep.
The allocations should be there. But with that said, it never ceases to amaze me how often they're not. I mean, and that's where I'm going to once again stress, get good tax people, because those numbers are not ambiguous. They're there, and the depreciation is based on it. And think about your return on investment depreciation, what you're taking depreciation-wise. The more you jack up the value of the assets to depreciate, the better your return on investment is. So, and that's one of my biggest beefs is, even on a rental house, who makes the allocation dirt to improvements? Mm-hmm. And if you talk to our friend Jonathan, who's in the cost seg world, then you're just that's cost seg is just allocations on steroids, right? I mean, so you're front loading a lot of depreciation, but you got to look at that, and that's where the good tax people are going to make those allocations. So to your point, or what you're trying to get me to talk about, is loan to value. We don't want you to say, hey, I'm buying this property and all the 1031 money is going to the 1031 component, and I'm buying the residential component, nothing down. That's not something that's going to work if you got audited. So our advice is going to be, you should mirror the LTV on the residential and income property components if that's what we're looking at.
Right.
So make sure that loan to value is the same. If you're buying something and it's 3-to-1, you need to come in with the same ratio of down payment on the residential component or the non-qualifying component, whatever that might be.
Absolutely. And we also know that we can sell an investment property and purchase something that eventually will be our primary residence, but there are some additional rules to that as well. And so I know that you've got to purchase an investment on the other side. Anytime that you're doing a 1031, you're holding that property for investment when you purchase it. So, David, why don't you talk about the additional rules that apply should you choose to move into that property?
So think about for those of you out there that are of my vintage or older, probably, you think about the situation where in 1997, pre-97, we had Section 1034. And that said if you lived in a home for, 2 years, you had a one-time lifetime exclusion of was $125,000, which didn't do much for you, but it was an exclusion again. I mean, you had 2 years to buy a new home of equal or greater value. So with people buying up, it worked. It worked very well. It was just when you wanted to get out that it was going to hit you. So in 97, when the 250 and 500 came in to replace that one-time lifetime of 125, everybody was very excited about it. Now, fast forward to 2021, and 250 and 500,000 in gain doesn't mean much of anything for a lot of people. So we've got lots of situations, number one, where you might have a residence, and we've got a class that I present, and we've got a page. It's like, what are you selling? Actually, we've got a class coming up that we're covering this. It's like, what is it? What do you want it to be? Basically, what do you think it is, and what do you want it to be? Do you want it to be your home? It might be your home. Do you want it to be your home? Is it investment? Do you want it to be investment? And the point of it is you can take an investment, convert it to residence. You can take residence, convert to investment. I'm going to answer your question. So Tina, so Tina asked about, the acquisition, what has to happen, and the path to home ownership from an investment. You're giving up the investment property. You're going to buy a new property, and you ought to hold it for investment for whatever you and your tax people feel is a reasonable period. I would say a year, based upon two factors. One, it's been proposed several times. Two, the break between short and long-term tax rates on assets held for investments at a year, at least for now. So I think that's safe. Sometimes tax people say 2 years, and they say, well, it says 2 years in the code. Well, it doesn't. If you and I are brother and sister, it might have, that's a related party transaction. We've got 2 years, but not an absolute even in that scenario. But with outside of that, there's no state required hold. And there is a court case, like I said earlier, where 4 months was deemed long enough. People bought a property, couldn't rent it out, argued hardship, moved into it, and successfully defended it in court. So let's say you do this, you make the acquisition, you move into it. And the idea was, and it worked, between 97 and 2000, you could go and buy a property via 1031, hold it for a year, move into it, live in it for 2, sell it, take the exclusion, get rid of all your gain.
But that's changed.
And then right around 2000, the government saw this happening, and they said, okay, we're going to put a 5-year required hold in place. Well, that slowed it down. And what that meant is if you bought a property, and that still applies, if you buy a property via 1031, move into it, even though you've met the 250 or 500, the 2 years required for that, if you sold it inside 5 years acquisition, it's going to be a fully taxable sale. That slowed it down. Go forward to 2008, and we've got the Housing Assistance Tax Act. Now, we're going through a whole bunch of tax measures right now, and I just love the way they title these things. The People's Relief Act of whatever it is. Well, the Housing Assistance Tax Act doesn't assist you at all. It sticks it to you. Right. So what it says is yes, if you acquire a property via 1031, hold it for, let's say whatever, maybe it's a year, then you move into it, you hold it more than 5 years, because remember, if you sold inside 5 years to be fully taxable, you get outside the 5 years, that's when the Housing Assistance Tax Act is going to kick in. And that basically is going to give you a proration of Section 121's 250 or 500, and that proration is based upon the gain attributable to the qualified versus non-qualified use periods from April of 2009 to the date of, disposition. So, let's say you did a transaction. Now you've held the property maybe from 2000. Well, whatever that thing was at 2009, from that date to the date of conversion, it's non-qualified use. And then if you've moved into it, then the time you've lived in it, it's a qualified use, and you're going to look at that ratio. So on the bright side, you can do it.
Yes.
And we have a pathway to it. So every time the government puts rules in place, they validated a process. They've said we can do it. The downside is you just have to wait a while to do it. And what I tell people today is it's an end game. It's not don't do it if you think, hey, I'm just going to buy the property, hold it for a few years, and then sell it, take the exclusion. I'm going to save all this money. It doesn't work that way anymore. If you want to buy a place, retire into it, live on the beach, stay there for the foreseeable future, then use it. It's there and it works great.
And so thank you for all the answers to the questions. And yes, you call us. We have the guys with the answers. That's the beauty of this.
You're one of us.
I'm one of the guys.
Yeah.
And so what we have learned today is, yes, you can purchase an investment property on the other side. You can turn it into a principal residence someday. You will have that proration of tax. On that end, you can purchase from a family member if that family member chooses to do an exchange as well. And we can also, make sure that you sell the property and you are looking at the value of the property you're selling, and make sure that you're purchasing at that same value or greater on the other side to be fully tax deferred. And so I just want to thank you for joining us today. Again, I'm Tina Colson. David Moore, Equity Advantage, 1031exchange.com, and we have a lot of information on flyers, videos, and the resources that you need. If you have any questions, always reach out to us, 503-635-1031 or 1031exchange.com. Thank you again for joining us today.
Thank you, Tina.